Hello and welcome to episode 2 of Manulife Asset Management's Investor Education video series. I'm Zed Matubis and today we will discuss the strong performance of one of our funds, the Manulife Dragon Growth Equity Feeder Fund, and the outlook for Hong Kong and China equities. Joining me today is our Head of Wealth Solutions, Paul Lu. Hello, Paul.
Hello, Zed. Happy to be here.
Paul, I'd like to start off with the strong performance of this fund year on year. As of end of August, the fund had a remarkable one-year return of 41% for its dollar share class and 31% for its peso share class, making it one of the best performing equity funds in the country. And that's despite the elevated market volatility induced by the COVID-19 pandemic. What are the key drivers of this impressive performance, Paul?
Both the fund and the benchmark did well, but the fund outperformed the benchmark by almost 9 percentage points. And this was because of superior stock selection by the portfolio manager. Meaning, while the general performance of Hong Kong and China equities was indeed good, the portfolio manager actually added more value and enhanced the return.
9 percentage points. That's a solid outperformance, Paul. By the way, the portfolio manager of this fund, Mr. KK Chai, is our managing director for Manulife Investment Management Hong Kong and will be speaking at our upcoming public webinar on September 17. So I encourage our listeners to please watch out for this webinar. Going back to the performance of the fund, Paul, what are the main reasons for the strength of Hong Kong and China equities over the past 12 months?
Well, Hong Kong and China equities didn't move up in a straight line. Similar to other global equity markets, worries about the coronavirus triggered a sharp sell-off in the early part of the year. But after a period of lockdowns and disruption, China appears to have contained COVID-19 infection rates. In fact, China was one of the first countries to restart economic activity. Their economy has already bounced back to growth, with second quarter GDP up by 3.2% after a decline of 6.8% in the previous quarter. In some ways, this pandemic has given light to the core strength of China's economic fundamentals. For example, the 2020 GDP growth estimate for China is still positive at 3%, implying an even stronger recovery in the second half of the year. This forecast also compares very favorably to the rest of the world, where GDP is expected to fall into negative territory for the year. Looking ahead to 2021, the GDP growth estimate for China is even more impressive. Even with a high base, China's GDP growth is expected to accelerate to 7.7%, which still outstrips the growth of developed markets.
Wow, so China's recovery is expected to continue and will be ahead of most other economies until 2021. For the fund manager, Paul, what has he done to beat the benchmark by 9 percentage points the last year?
The fund's performance has clearly highlighted the benefit of active management, especially when navigating through volatile conditions. The fund's performance really started to distance itself from the benchmark when the coronavirus rocked equity markets. But the portfolio manager already took positions in quality growth stocks, which were exposed to lasting investment themes such as consumption upgrade and research and development. Because of this, the fund held positions in several companies that withstood the uncertainty. Examples would be online education and e-commerce companies that even saw increased penetration due to the pandemic, and biotech companies that were developing related vaccines and drugs. One other thing I want to highlight is the portfolio manager's ability to select quality growth stocks across the entire market cap range. For example, small caps in the fund, which is about 7% of the portfolio, had rallied more than 34% in the first half of 2020, while those in the benchmark dropped nearly 26% in the same period.
That is indeed great work from the portfolio manager, Paul. With the strong performance so far, what is the outlook on Hong Kong and China equities, and how is our portfolio positioned given this outlook?
The macro uncertainties and heightened volatility brought by COVID-19 are still lingering, but we're cautiously optimistic on Hong Kong and China equities for the rest of the year. We take comfort in China's fiscal and monetary actions to support the economy. We also expect a recovery in corporate sales and earnings, as well as a resumption in corporate capex spending. Over a mid to long-term view, we see potential opportunities in the secular trends mentioned earlier. Consumption upgrade is still a dominant theme and accounts for more than half of the portfolio. Within this theme, we continue to hold positions in e-commerce, education, and property management. In fact, we've recently increased our exposure by investing in platforms for online entertainment and food delivery. R&D and innovation is also a large position, accounting for more than a fourth of the portfolio. Here we can find some of the more unique growth stocks in social media and mobile gaming companies, biotech companies, and suppliers for 5G technology. Lastly, a tenth of the portfolio will capitalize on new policies, including companies that benefit from import substitution in tech and healthcare, as well as companies that could participate in upcoming infrastructure stimulus measures.
Thanks, Paul. Those were indeed great insights for our clients who have invested in Manulife Dragon Growth Equity Feeder Fund, and for those who are still looking to invest or add. I believe the outlook you presented provides compelling reasons for long-term investors to consider the fund, depending on their investment objectives and risk profile.
Thank you, Zed, for the opportunity to share my thoughts on the fund and the Hong Kong and China equities market.
That ends our second episode of our investor education video series. In our next episode, we'll share our insights on the potential impact of the possible flattening of the COVID-19 curve on the key sectors of the local stock market. Thank you, everyone, and stay safe.